There's a mistake almost everyone makes when they try to get rich, and it has nothing to do with picking the right stock or finding the next big trend. It has to do with how they think. Charlie Munger spent more than 6 decades as Warren Buffett's partner at Berkshire Hathaway, and he believed most financial failure isn't a failure of information, it's a failure of thinking. He never chased headlines, never tried to be the flashiest man in the room. He built a fortune worth billions using a small set of thinking tools most people never learn in school and never hear about at work. What if the gap between the people who struggle with money and the people who thrive isn't intelligence or luck or connections? What if it's something you can actually learn? 12 of Munger's mental models are coming up, the ones he leaned on to make the calls most people get wrong. Stick around for the last one. It might be the one that mattered most to him. Munger wasn't born into money. He grew up during the Great Depression in Omaha, Nebraska, in a house where every dollar had to answer for itself. He studied mathematics, then law, not finance, and that's part of what made his mind so unusual in the investing world. He didn't think like a stockbroker. He thought like someone trying to solve a puzzle with whatever tools, work borrowed from psychology, physics, biology, history. It didn't matter where they came from. When he teamed up with Buffett, he pushed the company away from buying cheap, mediocre businesses and toward buying wonderful ones at a fair price, a shift that helped produce one of the best investment records in modern history. The dollar amount isn't really the interesting part, though. The reasoning underneath it is. And that reasoning works outside the stock market too, in business, in relationships, in the small decisions you make every day without noticing. So let's start with the idea that shaped most of what he believed. Call it inversion, and it's a strange place to start because it asks you to solve problems backward. Most people, when they want to succeed at something, ask how to succeed. Munger thought the better question was the opposite one: how could this fail? And how do I avoid that? It sounds almost too obvious to matter until you picture how differently people would act if they actually used it. Want a good marriage. Don't just study what makes marriages work, ask what wrecks them: contempt, dishonesty, neglect, and build your habits around staying away from those. Want a business that survives? Figure out what kills businesses: running out of cash, ignoring your customers, growing faster than you can manage, and organize your strategy around dodging those specific traps. Munger once said Buffett and people like him got a remarkable long-term edge by trying to be consistently not stupid rather than very intelligent. That line does more work than it seems to. Avoiding a catastrophic mistake is often worth more than making one brilliant move, because a single disaster can wipe out years of gains. Inversion just makes you look at the landmines before you step on one. Once you start thinking that way, you notice failure usually isn't mysterious. It follows the same patterns over and over, which only matters, though, if you also know where your own knowledge runs out. That's the circle of competence, Munger's second tool. He cared less about how big your circle was than about knowing exactly where its edges sat. You don't need to be an expert in everything. You need to be honest, almost brutally so, about what you actually understand versus what you're guessing at. That's uncomfortable because admitting the limits of your knowledge can feel like a confession of weakness. Munger read it the opposite way. Knowing your limits is what protects you from the confident ignorance that wrecks portfolios and reputations. Berkshire avoided heavy bets on certain fast-moving tech sectors for years, not because the industries were bad, but because Munger and Buffett didn't trust their own ability to predict where those industries would land. People called it old-fashioned. It also kept them out of some of the ugliest collapses in market history. The circle isn't fixed either. It grows, but slowly, through real learning, and pretending it's already bigger than it is tends to be expensive. Where are you operating outside your own circle of competence right now, without quite admitting it? That single question can save you from a costly mistake. But staying inside your circle doesn't make decisions free. Every choice, even a good one, comes with a cost that most people never bother to calculate. That's opportunity cost, the third piece. Every choice is really two choices: what you're getting and what you're giving up by not choosing something else. Munger and Buffett applied this without much sentiment. Before buying anything, they didn't just ask whether it was a good investment. They asked whether it beat the best other thing they could do with that same money, including doing nothing and just holding what they already owned. Most people skip that second question entirely, evaluating each decision as if it exists in a vacuum, as if the world only ever offers one option at a time. But time, money, and energy all run out. An hour spent on one thing is an hour not spent on something else. Berkshire held large piles of cash for long stretches, not out of laziness, but because nothing available was good enough to beat what they already had. Turn that lens on your own life, the job, the routine, the relationship you've kept simply because it's familiar. Would it survive being compared honestly against your best alternative? Opportunity cost has a way of forcing clarity you didn't ask for. Clarity alone won't help, though. If you can't sit still long enough to act on it, patience for Munger wasn't passive, it was work, and one of the hardest kinds because it fights against instinct. People are built for action. Watching opportunities pass by while doing nothing feels almost physically wrong. But Munger talked about investing success as mostly sitting on your hands, waiting for the rare setup where the odds are heavily in your favor, then swinging hard when it finally shows up. He liked the baseball comparison. A hitter doesn't have to swing at every pitch. And in investing, there's no umpire calling strikes while you wait. You can let 100 mediocre opportunities go by without penalty. That idea cuts against almost everything the modern world preaches about hustle and constant motion. Munger thought most investors underperform not from a lack of smarts, but because they can't resist the itch to trade, to act, to feel productive. Patience isn't laziness. It's refusing to pretend that every day holds a great opportunity when most days simply don't. The same thing shows up outside investing. Career moves made out of restlessness, relationships rushed before anyone really knows the other person, purchases made because waiting felt unbearable. But patience without somewhere to go is just stalling, which is where the next idea comes in. Munger thought in decades, not quarters. Wall Street, like most of modern life, runs on short-term results. This quarter's earnings, this week's progress, today's win. Munger largely tuned that out. He believed real advantages come from stacking good decisions on top of each other over very long stretches of time, and that chasing short-term wins usually erodes the foundation long-term success depends on. That's part of why Berkshire held certain businesses for decades rather than cashing out the moment a stock ticked up. He wasn't trying to win the month. He was trying to win the lifetime. A struggling business with a strong future looks completely different if you're willing to wait 5 years to judge it. A skill that takes half a decade to build looks worth the trouble if you're thinking in decades rather than days. Most people optimize for how this week feels. Munger optimized for how the next 20 years would look, which meant tolerating boredom and apparent underperformance now in exchange for strength later. None of that works, though, unless the decisions along the way are actually rational, and Munger had a lot to say about how hard that really is. Rationality, in his telling, wasn't a personality trait. It was a discipline you had to keep practicing because humans aren't naturally rational. We're emotional, biased, easy to sway, and pretending otherwise is its own kind of irrational. He didn't mean being cold or robotic. He meant noticing your own emotional tendencies and correcting for them on purpose. Most bad decisions, in his view, don't come from stupidity. They come from letting emotion, ego, or social pressure override clear thinking. This is why he took psychology seriously, not as trivia, but as a survival skill. Understanding your own mind and other people's mattered more than any spreadsheet. He wasn't chasing the satisfaction of being right in the moment. He wanted to be right over time, which sometimes meant saying he was wrong and changing course without his ego getting in the way, something most people find nearly impossible because they'd rather defend a position than update it. Even a rational person, though, can get pulled toward bad behavior if the system around them rewards the wrong things, which brings up incentives. Munger spent a lot of energy studying incentives because he thought they shape behavior more than intelligence or good intentions ever could. Show him the incentive, he liked to say, and he'd show you the outcome. That's not cynicism. It's an honest read on how people, even decent people, respond to the systems they're inside of. A salesperson paid purely on volume will oversell. Not because they're a bad person, but because the structure pushes them there. A manager judged only on this quarter's profit will often sacrifice next year's health to hit this quarter's number before buying into a company. Munger wanted to know how the people inside it got paid and promoted, because that told him more about how they'd behave than any mission statement would. The same logic runs through every workplace, every negotiation, every relationship, incentives quietly shaping what people do underneath whatever they say they're doing. Learning to spot them is close to a superpower, and once you can see incentives clearly, the next step is understanding the thinking errors those incentives tend to trigger. Munger spent years cataloging what he called the psychology of human misjudgment, a running list of the predictable ways the brain gets things wrong. It's less a single idea than a whole toolkit for catching your own bias, overconfidence, believing you know more than you do, confirmation bias, hunting for evidence that agrees with you and ignoring what doesn't, social proof, following the crowd even when the crowd is obviously wrong, because being wrong together feels safer than being right alone. Loss aversion, letting the fear of losing something outweigh the appeal of gaining something of equal value. Munger thought spotting these patterns in yourself mattered far more than spotting them in other people, because self-deception is the most dangerous bias of all. Everyone can see bad thinking in someone else's choices. Almost nobody can see it clearly in their own. That's part of why he read so widely, because these traps show up in medicine and politics just as much as in finance, and recognizing the pattern in one place helps you catch it somewhere else. Intelligence doesn't protect you from any of this. Awareness does, which brings us to a force Munger called one of the greatest secrets in finance. Compounding sounds simple on the surface. Money that earns returns and then earns returns on those returns grows faster and faster the longer it runs. Munger didn't treat it as just a financial idea, though. He applied it to knowledge, relationships, reputation, all of it. Reading constantly and refining his own thinking. Year after year, let his understanding of the world compound the same way money does. He said few things matter more than grasping both the power of compounding and how genuinely hard it is to pull off. That difficulty is what people underestimate. It takes patience, consistency, and the discipline not to break the chain, because one bad decision, one moment of panic, one shortcut taken out of impatience can undo years of compounding in a single afternoon. That's part of why Munger was so protective of Berkshire's long-term hold-ins and so wary of unnecessary risk. A dollar lost wasn't just a dollar, it was everything that dollar might have become over the following 30 years. Skills compound, relationships compound, reputation compounds. Small efforts, repeated without interruption, eventually produce results that would have looked impossible from where you started. None of that works without a reliable way to make the decisions that feed the process in the first place. Munger approached decisions the way an engineer tests a bridge, checking it from a dozen angles before he trusts it. Most people rely on a single mental model, one lens, and that leaves them blind to whatever that lens can't see. His answer was what he called a latticework of mental models, borrowing from psychology, economics, physics, biology, and history, and reaching for whichever one actually fit the problem in front of him. Look at investing only through the lens of finance, and you'll miss the psychology driving a bubble. Look at people only through the lens of stated intentions. You'll miss the incentives quietly running the show underneath. Combining models gave him a far more accurate picture than any single framework could, no matter how good that framework was on its own. That's why he reads so broadly, not for fun, but because every field hands you tools that sharpen decisions in ways you wouldn't expect. A concept from biology might explain competition in business. A principle from physics might explain why a system eventually snaps under pressure it's been absorbing quietly for years. His edge wasn't one brilliant insight. It was triangulating between a dozen decent ones until the picture came into focus. Once your process is sound, the next question is how you apply it to actual value. And this is where Munger changed Buffett's whole approach to investing. Early on, the standard playbook was to buy statistically cheap companies regardless of quality because the numbers looked good on paper. Munger pushed back on that. He argued it was better to buy a wonderful company at a fair price than a fair company at a wonderful price. It sounds like a small distinction, but it reshaped Berkshire's entire strategy away from hunting bargains in mediocre businesses and toward paying up, sometimes considerably. For businesses with real staying power and strong management, quality compounds. Cheapness by itself usually doesn't. A weak business bought at a discount can still fail. A strong one bought at a fair price and held for decades can multiply many times over. That takes a different kind of judgment, recognizing genuine quality instead of just an attractive ratio, and a fair amount of humility, because judging long-term strength is a lot harder than doing arithmetic. The same idea holds outside investing. Chasing the cheapest or easiest option in a career or a relationship or almost anything else tends to cost more down the line than paying a fair price for something genuinely good, which leaves the model Munger seemed to treat as the foundation under everything else. Lifelong learning paired with independent thinking. People who knew him described him as a learning machine, someone who read across every subject he could reach, not because he had to, but because he thought the world rewards whoever keeps expanding what they understand. No one in his view gets to stop learning once they've had some success. The moment you assume you know enough is roughly the moment you start falling behind. But learning by itself wasn't the whole thing. It had to come with the willingness to reach your own conclusions and hold them even when they went against whatever the crowd currently believed. He and Buffett took plenty of criticism over the years for skipping trends everyone else was chasing, only to watch some of those trends collapse later. That kind of conviction takes more than intelligence. It takes the nerve to stand apart, the patience to wait while everyone else moves, and enough trust in your own reasoning to hold a position that feels lonely for a while. It might be the hardest of the 12 because it asks you to build your own judgment slowly and honestly instead of borrowing confidence from whatever everyone else currently believes. Put it all together and a pattern shows up. Inversion keeps you from the worst mistakes. The circle of competence keeps you from overreaching. Opportunity cost keeps you from wasting what little time and money you have. Patience keeps your impulses in check. Long-term thinking keeps the noise from drowning out what actually matters. Rationality keeps your own emotions from running the show. Understanding incentives lets you see what's really driving people around you. Catching human misjudgment protects you from your own blind spots. Compounding rewards whatever you manage to protect long enough. A latticework of models keeps you from getting stuck in one narrow view. Choosing quality over cheapness keeps you from settling. And lifelong independent learning is what holds the other 11 together, because none of them work without a mind that keeps sharpening itself. Munger didn't get rich off one brilliant insight. He got there through decades of steady thinking, applied again and again long after most people would have gotten bored or distracted. That's really the whole secret behind these 12 ideas. Not genius, not luck, just a mind that trained itself year after year to think a little more clearly than the world around it. If even one of these changes how you make your next decision, this did its job. And if any of it landed, stick around for more of these deep dives into the people who shaped how we think about money and decisions. Munger's fortune was never really the point. What he left behind was a way of thinking, and that part's still free.